for her expectations on the Bank of Canada's announcement. We're going to be joined by Diana Avigdor. She's a Vice President, Portfolio Manager, and Head of Trading, because we're going to find out what it means for traders. Diana, when you're going to be sitting on the desk in an hour's time, what are you looking for? Will they, or will he, or won't he?
You know, he is not giving us any indication or forward guidance, which is okay. I think that is not a bad thing. I'm with consensus. I don't think he'll do anything. There are several reasons. I think that it's wise to keep your bullets in your pockets to use when you need. I did hear the previous commentator that he thought he should do it now while it's necessary. Well, the bank earnings were not so bad. And that's about all we can say about the bank earnings, as the earnings were set up to be very disappointing. But we can see that negative things have not seeped in as of yet, if they will. We have a U.S. economy and our biggest trading partner doing relatively better. We need our manufacturing to come back with the way commodities are. Maybe we wait to see how it's working out. We also had a better GDP number. Granted, it was an inventory build. Inventory build can be taken in two ways. Either you'll need it and you'll sell it later, or it's a build because there is less demand. So, you know, on either side of we'll see. So he has the opportunity to wait and see. I did hear certain bond traders, they do expect a rate cut, and given how unexpected Mr. Poloz has been, that's not out of the question. There is no comment from him today, and there is no press conference either, so it'll be a one-line surprise, and that's it.
One-line surprise, if it is a surprise.
Yes.
When we talk about the markets overall, you mentioned the banks. They're up about, let's call it 7% from their lows. The numbers came in pretty decent. Analysts are saying, though, that it's early days. Oil prices really only just fell. The rate cut only just happened. Are the banks, in your view, a place to hide in Canada or a place to step away from?
I think, you know, and we discussed this about the shorting of the banks out of the U.S. and other global markets. There was a very popular trade, and we saw that in a short interest of our financials before the earnings. They were very high. Short interest was very high. The trade was set up that the earnings were going to be very bad because of the dollar, the Canadian dollar, because of energy, because of a housing market, because of an economy, so that they were going to do very poorly. And when they didn't, there was a lot of short covering. So they're off their lows quite substantially. You and I also discussed some yield support. Some of these banks, is it a place to hide, to your question? Yes and no. If you are mandated to stay in Canada, if you are an asset manager or an investor that must stay in Canada, the financials with their yield support, some of the REITs, some of the discretionary, BlackBerry is acting well. Some of these places are a good place to hide. We at Barometer, we have been moving outside of Canada for the period of time that it is relatively underperforming. We have both currency in the US dollar that is working for us in the translation, and there are more options. So yes, if you have to be mandated to stay in Canada, it's okay. I do think that if there are some negative economic flows, I think the financials can trade lower, and the yield support could be 1 to 1.5% lower before, if we go into a very, say, negative economic situation, in which case Mr. Poloz is going to cut the rates as the negative commodity trade seeps into the earnings. If that happens.
Diane, I just want to interrupt you because right now we've been at new highs essentially on most of the major U.S. indices, certainly cycle highs. And you have an interesting comment. The hardest thing to do in a bad market is to be a good seller, but the hardest thing to do in a good market is to be a good buyer. Some people would say we're in a good market, certainly in the U.S., and we want to stay there. We want to be buying maybe the new high list. Is that where you are as opposed to being a good seller right now?
Yes, you know, this is a very hated rally. And people just recently have started comparing the NASDAQ of today to the NASDAQ of 2000, you know, being at the same level and how it's different, how it's cheaper. The S&P too broke out a couple of years ago. But, Bank of America Merrill Lynch has put out a report, 5% cash levels at major asset managers. In the aggregate, in its totality, that is pretty high. Strategists are recommending about 52% into equity allocation. You are going to get a turnover here where analysts are going to put out reports to take profits on this because it reached targets, because the PEs are XYZ, they're too high. But earnings, prices go up before, and then earnings catch up. So the multiple expansion can go on for a lot longer, and it's just sort of the beginning. So yes, it's hard to buy here. It's tempting to take profits.
But you are more of a buyer than a seller. I want to get to one last thing, Diane, if I could, and this is a graph that people bring out periodically. We're going to bring it out today for our viewers. This is velocity of money. Economics 101 says that it's money times velocity gets you the growth in GDP. You got lots of money out there, but it ain't moving around. Going forward, is this where we could see pleasant surprise if this money starts to spread around, because we're at record lows here, or essentially, certainly, decade lows?
So here is the outlier commentary. I can't wait for the first rate increase out of the Fed, because what you see in that velocity of money is the embedded expectations. And the expectations are that rates are not going anywhere, that I can get capital for cheap forever. I don't need to do anything. It's forever low. Money's not moving, nothing's spurring. So as the rates, well, at least the first quarter point, there is a message in there that will hopefully and maybe spur that money to start moving, which is great for capital markets. Yes, it may start an inflationary trend, but we're off such a low level, and I'll take inflation over deflation any day.
I'm with you on that last statement, Diana. Thanks very much.
Thank you.